All right. Howdy, howdy. Welcome, guys. Live at 5. My name is Jeb Smith. We have Josh Lewis here. For those of you who have been here before, welcome back. For those of you who are new, welcome to the show. We're here to talk about real estate and mortgage, answer your questions, whether you're a first-time home buyer, somebody moving up, you're an investor, whatever it is, we're here to help. So, Josh, welcome to the show, my friend. How are you this week?
Not too bad. I wore my special hat in case anyone forgot who I was. I just wanted to make sure that they got it. And if you're in South Carolina, anywhere near Charleston, go to Lewis Barbecue. It's spectacular.
You wore that so they actually knew how to spell Lewis this week?
Yeah. Instead of Luis, Jose Luis.
So yeah, guys. So where are you watching from? What are you seeing in your market right now? Interested to know. Here in Southern California, we talk a lot about my market, right? Just because that's where I'm located. Every week I update you here on our local inventory. Today, Orange County, 1,839 homes, 3.3 million people, 1,839 properties, including condos, single families, includes senior living, all of that. Guys, not a lot of property, right? We're down, probably 100 properties from last week. I think last week we were in the 1900s, maybe even 2000 last week. It might have moved up a little bit. So down about 5% or so here locally, Huntington Beach, 127 homes. So seeing property come on the market, seeing it go right back off, a lot of multiple offer situations, at least, working on buyers that I'm putting in offers on, and even properties I've had listed. Every property I've had listed has had multiple offers, not just one, but 3, 4, 5 offers. So we saw a little bit of positivity today with regards to the 10-year, right? 10-year, the interest rates aren't based off the 10-year, but they tend to flow in the same direction. And so, interest rates maybe getting a little bit better. Josh, why don't we talk about that for a minute?
Yeah, no, we had been going back and forth, or not even back and forth, just back down. Rates worse for what? We've been talking probably about a month now. If you look at that chart, just nothing but bad news. And the primary driver of that has just been a fear of inflation. We've seen inflation. We've talked about this before. We talked last week about us not having a super long-term concern of inflation because it's mainly supply-driven inflation. It's not demand-driven. Read an article from a gentleman that I respect greatly who was making the argument that it is demand-driven, that there was so much stimulus put into the economy that people are now going out and buying all sorts of things. So in addition to the supply issues, we have demand, high demand, problem getting the things to the people that want to buy it, and it's leading to this inflation issue. Either way, I do not believe that the inflation is a long-term problem, and I think what we saw this week is a little bit of the markets just being happy that the Fed finally stepped up and said, we're going to stop the stimulus. So the first step in stopping stimulus, you remember when COVID got real serious, real fast, the Fed dropped the federal funds rate to 0, and they announced that they were going to aggressively buy mortgage-backed securities and treasury bonds. So the first phase of unwinding that is they're going to stop buying mortgage-backed securities and treasury bonds. They're going to do it slowly and deliberately. And we still don't have an announcement of when they're going to start this, but the market has concluded sometime in November they're going to unwind their buying, outright buying of treasuries and mortgage bonds. And I think the market's reacting to that, going, okay, good. We're taking away the punch bowl. Everyone's getting a little drunk. We're taking away the punch bowl. We're still going to need to see inflation get under control before we see anything like a decrease to where interest rates were even just 2-3 months ago. The longer term trend, which we've talked about 1,000 times here, is and will continue to be for lower interest rates. We actually had a question here. One of the regular viewers, Jeb, Logical Thinker, says, do you agree with the MBA's new forecast that 30-year rates could average 4% by fourth quarter of next year and even 4.3 by year end 2022? No, there's no world in which that happens. The MBA is notoriously wrong with these figures. I don't know who their economists are or where they come up with this, but the reason for that is the long-term impact of government over-indebtedness. So our government borrowing tons of money for non-targeted stimulus during this downturn. We know a lot of people were negatively impacted by COVID, and they probably didn't get enough help. And we all know we probably have 10 different stories each individually of people who got benefits from stimulus who had zero need for it. I know I received a check, and I'm like, why am I getting a check? I wasn't negatively impacted by this. So government borrowed to push all this stimulus into the economy. And that in the long run is deflationary. It was always thought to be inflationary. All of the academic research supports that it is deflationary because it decreases the velocity of money. We get questions here. I believe actually Logical Thinker had asked about this. Money supply is massive. The government's printing money and pumping money into the system. But we haven't seen any growth in GDP. And the reason why is the formula for GDP growth is money supply times velocity of money will tell you what we should end up with for GDP. GDP has been low because we have no velocity of money. And there's reasons for that, academic reasons for that. And the government borrowing and over indebtedness is shown for 100 years in over indebted economies around the world. So long way of saying, I don't think the nice little correction here that Jeb was referencing that we've seen the last 2-3 days is a big correction where we're going to go back to where we were a month or two ago. But the selling was a little overblown. Looks like the markets are concluding that the Fed is going to take this seriously, take away the bond buying that they've done for too long, and at some point next year they'll start raising rates. And the important part to know is people go, oh shit, they're going to stop buying bonds. Well, then rates are going to go up. The last 3 times they've taken away quantitative easing, we've seen an improvement in yields. And we've always seen that relationship that when the Fed starts a tightening cycle in terms of increasing interest rates, you see rates in terms of treasuries and mortgage bonds improve because it lets the market know that the Fed is serious about fighting inflation and not letting it get a toehold. Right now, we're seeing hot inflation numbers and no one knows quite exactly why because we're in a weird economy right now. But most everyone has looked at the Fed and goes, these people have kind of lost the plot here. We're seeing inflation get away instead of taking away the punch bowl. They're just going, it's not really a thing. So long answer to a short question, Jeb, we've seen some nice improvement. We'll probably see a little bit more improvement depending on what the GDP numbers are announced tomorrow. But it's definitely still a bearish market for interest rates and probably favors just staying locked and staying out of the way.
There you go. So, yeah, no, great answer. Some of that we addressed yesterday in a video, but there's, I mean, obviously a lot more that goes into that. Like you said, GDP comes out tomorrow, and you know, we were talking prior to this before coming on here. I'm going to remove Victor's question here, though, that you know the expectations for GDP are, you know, in the 2% range, right? And what happens when they come in higher than expected, which some people are expecting, you know, it's obviously, you know, it's going to be spun in a different way, which could impact rates negatively or whatever, right? So people read the headline without reading the actual details of what's going on, and it can be spun in multiple ways. So it'll be interesting to see what comes out. But like Josh said, if you're in, you know, in the market, and this doesn't just apply to right now, if you're in the market and you're within that 30-day window of closing on a home, you know, there's a lot of volatility right now in the market in general. It's you know, it's probably best case to just lock a loan versus letting things float and try to get another 1/8%. I mean, at the end of the day, I would say that the average loan out there probably is, you know, watching this channel is probably between $300,000 and $600,000. An 1/8% isn't really going to make that big of a difference on a loan that size. I mean, yeah, it's money, but at the end of the day, if it goes the other direction, you're always going to have that potential regret. So
You know, you've heard us say this before on the show. Every loan that I locked in the last 7 days was, I think the best rate was 2.75. The worst was either 3 1/8 or 3 1/4. So a pretty narrow half point range. And whoever that is, all of those loans are awesome interest rates. And what I can say is in the transaction, when Jeb puts someone under contract, we have the phone call and we run through rates and we lock it. The rate is incredibly important to them that day, and they know exactly what they're rating. Well, I want to lock 2.99 instead of 3.125, and it's very important to them. If I call them 90 days after we close saying, hey, John, just wanted to check in, see how things are going, see if you had any questions. If I ask them at that 90-day check-in and say, hey, what interest rate do you have? 70% will not remember accurately. I think we got 3%, or weren't we under 3%, or were we just over 3%? So it seems very important in the moment. It's not as important in the long run, because the reality is people stay in loans anywhere from 3 to 5 years. The last few years, it's been shorter than that. I wouldn't count on it always being a 1 to 2 year cycle of people refinancing, but we're going on 15, 20 years where every 3 to 5 years, you're going to sell or refinance. Getting, you know, hung up on paying money to get the lowest rate today is generally not beneficial.
no, good stuff. Victor, We're finally getting to you, my friend. Quick question on behalf of my roommate: is it better to continue renting from my friend for $650, or should I buy a small 2-bedroom, two bath condo for $300 and rent both the rooms? So I guess I have a question here. So if you're buying a 2-bedroom, 2-bath condo, if you rent both the rooms, then you don't have a room.
Where do you stay?
Yeah, where are you going to be? Are you going to stay with your friend? But no, in all seriousness, I would say, if you have the ability to buy something in this environment, and financially you're okay to do it, you have some money in the bank, whatever, having, and renting out a room to help you pay down your mortgage could really, on a $300,000 property, depending on what you put down, what's your mortgage payment on that, Josh? 300,000, give or take.
Less than $2,000.
Less than $2,000. You got somebody paying $650. Yeah, you're going to be paying more than the $650 you're paying right now for your monthly rent, but you get the mortgage deduction. You get, that forced savings by paying down that loan every single month versus paying for your friend's house or whatever it is, or the tenant, the landlord that owns the property that you're renting from. Plus, you get potential appreciation. If any of these forecasts are accurate for next year, if you just took an average on the low side, you got 2% coming from who is 2%? CoreLogic.
CoreLogic loves
CoreLogic's 2%. On the higher side, you've got Goldman Sachs saying 16%. If you just average those two, you got a lot in the middle. You got Zillow at 12. You got the National Association of Realtors at 5 or 6, somewhere in that ballpark. But let's just say an average 8%. That $300,000 home now, you've made $24,000 on that property in a year. Plus you've paid down the mortgage. Again, it's not the right situation scenario for everyone, but the fact that you're thinking along those lines is the right way to think. And so, but you need somebody to run the numbers. Talk to a mortgage professional, have them put down on paper, this is how much your payment would be. This is what it would be with taxes, with the HOA, with the insurance. So every single month what your monthly nut is, what you need to cover in order to take on that house. And if you're comfortable, then maybe it's the opportunity, the right time to do it.
Jeb, we talk about this all the time, that forced savings in the form of the principal portion of your principal and interest payment is massive in this calculation. And even though we talk about it all the time, I had a situation just yesterday. We're sitting here saying, okay, now the rubber hits the road. If you guys watch regularly, back about 3-4 months ago, we bought a house in Orange. It was destroyed, needed to be fixed up. We're almost done. And now we go, okay, are we really going to keep it and rent it, or we want to just sell it and ring the cash register? The thought was always we're going to keep it, but pencil out the numbers. And I look and I go, okay, payment's about $3,400 if I do the refinance that I want. What will it rent for? Rents for about $3,600 to $3,800. Like, geez, there's only $200 or $300 positive there. I thought there would be more. Well, then I run and go look at the amortization schedule. It's over $1,000 a month going to principal on that. So yes, on a month-to-month basis, I'm barely positive. And if you have a repair or anything go wrong at the property, you're a little bit negative. But it's $12,000 a year. Most people don't put $1,000 a month into their retirement account. But in that situation with a $600,000 mortgage, I would have $1,000 a month towards principal. So looking at this, I ran the numbers, but I should have been able to intuitively know, hey, yesterday, if you ran that at $600,000 and it's $1,000 a month, what would $300,000 be? So it's about $500 a month that you're paying. So at the end of the year, you're going to have $6,000 that you've paid the mortgage down. If CoreLogic is right on the low end, 2%, you got $6,000 more. You have $12,000 or $1,000 a month that you wouldn't otherwise have. We talk all the time. How many times has Jeb said, don't buy a home for 2 or 3 years thinking you're going to get in and get out and make a profit? If you're there for 5 years, now we're talking $60,000, $70,000, $80,000 that you wouldn't have otherwise have. So, we get people in the comment section saying, oh, these people are trying to pitch fear of missing out. It's not a matter of fear of missing out. You don't make a fear-based decision to jump into a market when home prices have elevated as much as they have over the last few years. But home ownership is really important to building wealth over the long haul. So as soon as you reach that point in your life where home ownership is a viable option, you need to do it.
Agreed. So yeah, I don't really think much needs to be said other than that. It's the math works, guys. Just do it. Talk to somebody and have them run the numbers. John's asking a good question here. This is something I get I don't really get it from clients per se, but I see it a lot online. Jeb, please discuss home warranties. Do realtors use them as a distraction? I've heard they're scams because they deny all claims. So the distraction thing, here's what I would say. Most buyers go into buying a property and ask for a home warranty with the idea. Well, a lot of times it's their realtors telling them that, hey, ask for a home warranty. And what is that? Let's talk about what that home warranty is supposed to do. So you go into a property, a home warranty is paid typically by the seller. It's supposed to cover the major systems of the house, right? It's supposed to cover the HVAC, so the heating, venting, air conditioning, all of that, ventilation, air conditioning, whatever. A dishwasher, water heater, some plumbing, some electrical, some roofing, depending on the type of roof, how much square footage, all of that stuff. So the major stuff. So if you get into a property, something goes bad the first year, you pay a deductible, usually $65-$70. They come out, analyze the situation, and say, you know what, the water heater is disrepairable, it's unrepairable. It needs to be replaced. And so therefore that home warranty company would cover it. Here's the caveat. They're an insurance company, right? They're in the business of not paying claims if they don't have to. No different than a car company, right? You get in a car accident, sometimes you have to fight them to get it paid, so on and so forth. So with that said, yes, they can be a pain sometimes in getting things done. What I can tell you is that if you work with a good real estate agent, typically that good real estate agent has relationships with these home warranty reps. And so if something gets denied, all it takes is me making a phone call to my rep and I get that thing approved. So I've had garage doors before get declined, dishwashers get declined, water heater repairs get declined. Phone call, okay, it's getting fixed. It's that easy. But with that said, there are things that they're not going to fix, right? I mean, if you get a home warranty on a property, and you calling a week later that there's a claim on something that in the property that that went wrong, they might ask for a copy of the inspection report. If that inspection report brings back, hey, the hot water heater was leaking, yeah, you're going to have a hard time getting that paid. It's just, again, they're in the business of protecting themselves, not trying to spend any money if they don't have to. But there are ways to help you get around it. So would I recommend one? Depends. It depends on the house. It depends on the buyer, right? If you're a handy person, you're a contractor buying a house, you're going to gut it, like Josh is buying a house in Orange, and they're going to gut the thing. Probably don't need a home warranty, right? I mean, there's nothing going to be left in the property. Or if you're buying new construction, a lot of new construction stuff, it has a 10-year manufacturer warranty on appliances or hot water heaters or heating or whatever it is. In that case, you might not need it. But if I were buying a house that had maybe the furnace was older, the hot water heater was older, but wasn't leaking, you know what? It's a good thing to have for, maybe the first year in a property, just to give you, that time to get into the property and not have to really worry about something that could come up. So a long way of getting around to it. Is it a scam? It's not a scam, but again, they're in the business of trying to make money, and homeowners are having, are filing claims trying to get things paid. So it's a battle of, who's right and who's wrong. And you really need to know your stuff and be able to fight for it. And most of the times, if you do, you can get the stuff completed. So anything you want to add to that, Josh?
I would just say think about this. All insurance is designed for the insurance company to make a profit. So it's not something where you're going to most often say, well, I'm really, really glad I did it. It's there for something catastrophic. So like Jeb started by saying, it's for major systems. So the thing is, do I need a home warranty? Most times, no. But if I don't have it and the air conditioner goes out 6 months after I move in, I'm really going to wish I had it. So it's really just that peace of mind. And in a lot of situations, it's kind of become the standard where people ask for it and sellers are often willing to pay it. And if not, the buyer can pay for it themselves and the agent can pick it up for them. So it's really just peace of mind. You're probably not going to use it. You're probably going to lose in the long run. But if you have something catastrophic go out, you probably want it. Especially know your own situation. It's sort of like anything else. What type of major repair are they going to cover? At the most, Jeb, something that's going to cost $3,000, $4,000, $5,000, right?
Yeah. I mean, I've seen them have to replace a built-in refrigerator before. Those things $12,000, $14,000, depending on the brand, the model. Some can even be more expensive than that, and having to replace it. I mean, and then wanting to replace it with an off brand, and the people said no, and they actually got it replaced. And I think it was a G monogram at the time. And I mean, it was a big deal. And, that home warranty paid for itself many times over. So yeah, but here's what to go back to say, do realtors use this as a distraction? I would say a buyer's agent, I would never use that as a distraction, right? I'm trying to get my client the best deal. I'm trying to negotiate things up front. But what I can tell you as a listing agent, if my client is buying your client a home warranty, right? You've requested as a buyer that the seller pay a home warranty. And then you come back, for example, and say, you know what, the hot water heater is old. I want you to replace it. Well, my answer to you and to, talking to my client is, hey, listen, that hot water heater is not leaking. We gave you a home warranty. We're paying for a home warranty for the first year. If it goes out in the first year, it's paid for. So therefore, we're not replacing something that's not broken. My client wasn't going to replace that anyway. So it's working. It's functional. This is giving you some sense of security, with that. So can it be used as a negotiating tactic from the seller side? Absolutely. But it shouldn't be used to hide something or cover something up, if you will. So, all right. Let's see.
Jeb, there's a follow-up here. So someone just asked, great question on the home warranty. Can you recommend a company? We just had a question or a discussion, you and I, about one of our friends in the business here that works for a home warranty company. Mm-hmm. Which home warranty company do you use, and is there a reason why you prefer them over others?
It's here's what I'll say is that this business is a lot about relationships, right? And in the sense that you want to get a home warranty with companies that are reputable, and there are some big companies out there. I'll give you a couple of examples. I mean, I'm not going to say whatever, because I don't want to throw names out there, but Home Guard Home Warranty, First American, both pretty big companies when it comes to home warranties. So I go with, who can I call if that is not addressed, and I need to get my client, I need to get it completed for him, because
it goes back to that denied claim, right? So they say,
absolutely,
we're not replacing the water heater. Now Jeb gets involved.
Exactly right. So I'm going to go with not necessarily, one of the best companies, right? Maybe not be the top company per se for every situation, but it's, hey, if they deny this, who can I call that I know will get it done? And that's what it comes down to. It comes down to relationships to some extent, because I want to make sure that my client's covered on whichever side of it is. But there's companies out there, the companies I would recommend, like I said, are, the Home Guard Home Warranty, First American. There's a handful. I can't think of all of them at the moment, but those are the two that come up right off the top of my head. So,
and I would say the exact same thing that you said. Anytime I'm buying a property where I feel like I do need a home warranty, I want it to be, I would say I've always used First American, and it's basically because of that relationship with Roberta that I know that if I have a problem, I call Roberta. Roberta takes care of it. Right. Insurance is insurance. So you just want a claim covered, and that was my shortcut. So I don't feel like they're necessarily any better than the others. I've never had a bad experience with them. Anything that's been a problem, she's stepped in and taken care of for us.
No, there you go. Let's see here. John Doe, if I switch job industries, but my wife's been in the same industry for 15 years, will that hurt our chances on a joint conventional loan, Josh?
So does that mean that it's Jane Doe that has been in the same industry for 15
exactly
years?
What it means.
Or would that be his sister? I don't want to be presumptuous. So Jane's been in the same industry for 15 years. Will it hurt the chances on a joint conventional loan? I will go so far as to say, don't get hung up on changing industries, meaning that your income is no longer usable. So in the situation, let's say you were a plumber for 10 years and you go, hey, I just got a great job offer to go into pharmaceutical sales. They say I'm going to make $150,000 a year. I get a $3,000 base and potential to make $10,000 a month in commissions. That might be a perfectly reasonable decision for you to make, but you have no history of being able to sell. We don't have the history of the bonuses or commissions, so we're not going to be able to use it. Now, that same situation, you're a plumber. You have no history of being, an office manager, but if you've been on the job for 6 months and someone's paying you a salary to be an office manager, we can probably make a case to use that. So talk to your lender ahead of time. What job change or what career change are you considering? If they're similar, if they have probably a good example. We had a client, Jeb, a joint client a few years ago, that they were leaving the military, and we had no history on the new job, but their job role in the Army was the exact same as what they were going to be doing in the new job. No problem whatsoever. So don't get hung up on it. Discuss it with your lender. You should be fine. And if your wife qualifies on her own, then you have no worries. Go and do whatever you want. And I guess I'll answer a question here that wasn't asked here. A lot of times people get confused or are unaware that if one spouse or the other qualifies, they can still both be on title. So you can still be an owner of the property, you can still be put on title, and we just put the loan in the name of one borrower. So lots of options there. You want to talk through them with your lender.
All right. While we're talking about loans here, I'm just going to jump up this question here because there's two people that kind of are talking about it. Charles is asking, can I lose PMI based off home value appreciation and not having to refi? Locked in at 2.5, so great rate, doesn't want to refi, lose the rate, but wants to get rid of that PMI. Home's gone up in value. What do you do, Josh?
So the lender can require that you demonstrate an acceptable payment history. Generally, they're going to make you have it for at least 12 months. I believe they're allowed to require 2 years, so 24 months. But you're at 12. Reach out to your lender, explain the situation. They may do something where they use an automated valuation where they pull it up and go, hey, you're cool, fill out this paperwork and we'll remove it. They may require you to have an appraisal. Which you would pay for, and have an appraiser come out and confirm that the value is there, that you don't, that you're,
but
you have more than 20.
They're picking the appraiser, correct?
Generally, they're going to give you you call these people, order the appraisal, and we're going to get an appraisal that we're comfortable with. But 12 to 24 months of on-time payments, and most people haven't had late payments in the last 12 to 24 months, because if you couldn't make the payment, you just went into forbearance. But it's important to remember you have to have had an on-time payment history, because the whole reason for mortgage insurance is that it's insuring the lender in case of your default. If you've missed a payment, you've indicated that you may default regardless of the loan to value percentage. So Charles, in your situation, you've had it for a year, you've made 12 on-time payments, definitely reach out to the lender and ask them. They may say, yes, you can do it now, and here are the steps. They may say you can't do it now, you can do it in 24 months, and here are the steps. It's been nice the last few years with rates constantly dropping. You just say, don't worry about it. Call my lender, and we're going to do a refinance and get a lower rate and rid of mortgage insurance. But for a lot of the folks like you that are in 2.5, 2 3/4 interest rates, and rates are just a hair higher than that, you probably don't want a new loan. You just want to get rid of your mortgage insurance.
No, good stuff. And Ariana had the similar question. So hopefully that addresses both of those guys. Appreciate you being here and answering or asking questions rather. Carol's got a good question. In a small town outside Boise, Meridian, maybe, my property has more than tripled in value since a purchase in 2016. I'm worried about property taxes. Anyone addressing this? So this is fun. So I was actually talking to my business coach today, who lives in Boise at the moment, relocated from Southern California up there. He purchased about 4 years ago, which is about the time you purchased. And incredible. I mean, since he's purchased, he basically told me that his property has gone up. It hasn't tripled, but it's gone up, over double from where he bought it, maybe 150% or so since he bought it 4 years ago, which is nuts. But property taxes, is anyone addressing this? So here in California, we don't have to worry about that. And I know the rest of the states hate us because of that, but I don't know what states like this are doing, right? When you do have appreciation and growth like that, you're going to have some sort of supplemental tax bill, right? So where your taxes go up when they reassess, and typically this happens every year, every 2 years. I don't know what your options are in that case. I don't, unfortunately, us here in California, because we don't deal with that, I'm not familiar with it. Josh, is there anything you're aware of in these situations?
Yeah, and I'm trying to pull it up right now. Just here in May, Idaho governor signs property tax relief legislation. I need to read through the details, but there's a couple things. One of the things I do know about in Idaho, and it doesn't sound, Carol, like you're necessarily a senior. Idaho does have some protection for seniors, low-income seniors. If you can demonstrate that, hey, this is becoming a hardship, that my property taxes are going up, they give you a massive discount on your property taxes. We don't have that in California. We just have them limited across the board with Prop 13 to 2% annual increases for everyone. So I don't know how this would work out for you, but do a little research on this property tax relief legislation. It sounds like they just carved out the homeowner's exemption to a higher amount. And it has also raises property tax reduction for qualifying low-income seniors from $1,320 to $1,500. So they're doing some things, but the fact of the matter is it gets difficult. And this is why, how did we end up with Prop 13 in California? Because you go back to the 70s where California home prices decoupled from the rest of the country, where everyone had just had this slow and steady rise. You buy a house for $10,000 in 1930, you get to the 70s, it's worth $30,000. Well, magically in California, they went from 30 to 70,000, and people were like, my property taxes just doubled. My house is paid off. I bought it for 10 grand, 30 years, I paid it off, and now I look up and my taxes are more than double, and it was a problem. So we came up with a solution, a non-free market solution here, which we benefit from it. And it's so ingrained that after what we had about 43, 44, 45 years, that I don't know that they'll ever be able to get rid of it or should get rid of it. But there's lots of unintended consequences. It protects seniors from getting priced out of their homes by values exceeding their ability to repay the taxes or pay the property taxes, but it also does a lot of negative things. I'm personally, to a degree, Jeb and I just talked about this yesterday, trapped in my home because it's worth so much more than my Prop 13 tax assessment is. And you're like, oh, poor Josh, he's trapped in his home. No one says that. It's a nice house, but it decreases mobility. We talk about not having a lot of inventory here for people to choose from. Well, it's because people like me are going, well, I can't move. I just got to stay here in my nice house. So I think the other 49 states have looked at what California did and said, hey, great intentions, bad unintended consequences. And I don't think that anyone else will go down the same path.
No, good stuff. Esther's asking a question. Jeb, is it common practice to share your CD, so your closing disclosure, with your realtor? I wouldn't say it's common practice. I rarely see a CD from a client, but if they sent it to me, it wouldn't be. I don't think it would be crazy. It would be. I would tell you most people wouldn't even know what they were looking at, quite frankly, and most realtors would have no idea how to read it and even understand it. So it's probably. There's no real reason to send it to your realtor. But if you have questions about something that you're being charged or whatever, the best person to talk to, quite frankly, is the mortgage originator, the mortgage professional that you got the loan from. But if you feel like something is different and you want to run it by someone else, your realtor is just as good a person as any to have that conversation, I feel like. Josh, what I mean,
No,
you're on that side. So
yeah, I saw the question. I'm like, I like that because I don't think about it from anyone else's perspective. I just think that everyone in a transaction has access to the numbers. And I was like, no, it doesn't ever really go to a realtor. So it was interesting to hear that you don't really get involved in that end. The only reason I will say this, there are nosy realtors. Like I've had realtors ask us for a copy. I'm like, I can't give you a copy. Your client can give you a copy. You're not a party to our transaction. I mean, you are technically a party to the transaction, but not to our loan transaction. So I have no problem with that being shared with the realtor by the borrower. I'm just not going to do it. If the borrower sends me an email, hey Josh, please send my realtor a CD. So bigger picture, it's another experienced hand in the file who could take a look at it. So if you want them to look at it, by all means. If they're saying they have a need to look at it or review it, you don't really need to. As Jeb just said, he doesn't look at them very often,
yeah,
but
I have no reason to. Unless my client feels like they're being overcharged for something or whatever, there would be no reason for me to ever see a closing disclosure. I mean, no reason. So,
and it's probably useful, Jeb, to talk about because people still get hung up. They go, hey, can I get a good faith estimate? Or hey, can I get a loan estimate? So good faith estimate was replaced in the new sort of disclosure regime with the loan estimate, which the loan estimate is on the front end and it can be locked or unlocked. And the only difference there is the box A fees, which are lender fees. So broker or lender, the actual person doing the work on the loan, they all go in box A. And those are a zero tolerance once the loan is locked. When you say, hey, Josh, lock your loan, and we send out a loan estimate saying, hey, you're locked for 30 days at these terms, nothing in box A can change. Box B and box C have different tolerances based off of whether you can shop for them or not. But long way of saying, when you get to the closing disclosure, nothing could have changed or should have been able to change in a significant way where you can go, oh my God, I don't know where these numbers came from. So if they have, and you feel like you need to get your realtor involved, I don't have a problem with that. But if there's a big difference from loan estimate to CD, something's gone wrong and I need to get involved and go, whoa, how are these two different? We have very limited tolerance for variance from the locked loan estimate to the closing disclosure.
No, good. Let's see here. We got a couple questions here. Let's see. Some good ones. Let's see. I saw them and now I lost it. So say is asking, when will the price reflect on Zillow or Redfin of home sales? So whenever the MLS is updated in whatever area, typically it'll update within a couple of hours on Zillow and Redfin of a property sold. Like, for example, I closed one yesterday, maybe closed it on the MLS, and I got an alert from one of the websites a couple hours later, like, hey, your listing is showing closed or whatever. And so at that time, it's reflected. Sometimes, a property closes, the agent doesn't show that it's closed in the MLS for a couple of days for whatever reason. They get, just bogged down, forget about it, whatever. So it might take a couple of days, but usually it's pretty fast.
Jeb,
yep.
We got some crypto money.
Ooh, crypto money. Ooh, look at that. $5. So Josh and I have been talking about crypto, been reading about crypto. Neither of us have any at the moment, but I basically said at this point, any money that comes through the channel, we're just going to buy crypto with it. We're either going to go broke or we're going to be wealthy. One of the two. Like, I don't know what's going to happen here, guys, but we just bought $5 of something. I don't even. Yeah.
And we're not buying Ethereum and Bitcoin that's thousands
we're buying
of dollars.
Stuff that's
we're buying the ones that are like a tenth of a cent. So with our $5 there, what we get, like 5,000 shares for $5?
Absolutely. Yep. And then we'll even take recommendations. That's how we're doing this. Like, if you have one that you think's good, you tell us, we'll buy it.
But I don't want to.
You might have created your own.
I don't want a random recommendation though. What I want is, if you created an altcoin, name the altcoin and a one-liner of what you love about it and why we should take our super chat money and plug it in there. Zeb super chat money and plug it in there.
I like it. All right. So I don't know if Say's insulting us here or giving us a compliment. I think the channel should switch to more of a prerequisite. Know the 101. On the 101, I'm not sure. So
no, say is giving you a compliment. He's saying this is a prerequisite. Don't do anything without showing up to the channel.
I like it. I just, I'm just making sure I can, my comprehension isn't always the best.
Hold on, we got to go back to our crypto. We didn't answer Edgar's question. We got so excited about the $5.
We did.
Let's get Edgar his answer before we move on.
That's so good. We just took the money.
We got so excited about our 5,000.
We're like the people making altcoins. We just take your money and run. That's perfect. So Edgar says, what is needed for down payment assistance, and is there a downside to using the option? Can it be used with an FHA loan? So I'll say my piece and then let Josh give you the details on it. So typically, down payment assistance is never free. Right. So people think of down payment assistance as this free money that they are given to help them with the down payment. Typically, it's some sort of grant and a repayable grant at that. Right. I mean, is grant the right word, Josh? There's a loan. There's a loan associated with it. And maybe that loan doesn't have to be paid off immediately. At some point, it is paid off if you sell or refinance the house. Some of them take a portion of the equity. There's a lot that goes into these down payment assistance options, if you will. But can it be used with an FHA loan? Yes, is the answer. But Josh, what are your thoughts on these, and how many have you seen in these in the last 5 years?
So here's the crazy thing. We've done a handful in the last 5 years. And in California, so we got two questions. Edgar, I don't remember if you're in California or outside of California. In California, we used to have a ton of assistance programs. We have a sister website that my business partner runs called Find My Way Home. Find My Way Home from 2007 to 2011 was like the best resource online for information about California down payment assistance programs. And the reason why I say through 2011, well, in 2011, Governor Jerry Brown, decided that, hey, we need to balance the budget, and all of these city redevelopment agencies have money. Let's say we're going to do city redevelopment or redevelopment at the state level versus the city level, and you need to give us all your money. So you're shut down, bring the money back to the state level. So really in California, we only have CalHFA, the California Housing and Finance Authority. And the crazy thing is, I tell you, we've only done a handful in the last 5 years. The program's really grown exponentially. They did about $5 billion of loans last year, which blows my mind because it really is a lack of education. When we get an inquiry from someone who wants assistance, they've heard about CalHFA, and we run through the numbers. When I show you that it's generally a second and a third mortgage that has no payments required, little to no interest, but it's a lien there against your property. You're going to pay it back, and you're going to pay a slightly above market interest rate on the first. Most of our California buyers will go, well, what's the alternative? Say, well, can you come up with 3.5% down for an FHA deal? Because if so, we can get you a lender credit to cover all of your prepaids, all of your closing costs, and all you come in with is your 3.5%, and you have no second and third mortgage on there. It can also be done with a conventional loan. You were asking specifically about FHA. It can be done with a conventional loan, but 99 times out of 100, when I go through the details with a California borrower, they look at that and they go, no, get me that lender credit and let's pay the closing costs with that versus a second and a third mortgage. Now, that being said, other parts of the country have some excellent down payment assistance programs. You're generally wanting to look for programs that have grants. Jeb hinted at that. A grant, they're giving you money, you do not have to repay it. If there is a program that exists in your state where you can get free money, go for it. But ask, is this literally free money, or do I ever have to pay it back? If I have to pay it back, do I pay it back with interest? And then if the answer is yes, you have to pay it back, yes, you have to pay it back with interest, cool. What are my additional options for getting into a home with as little money out of my pocket, including using lender credits? So like the last thing I'll say on that, California, CalHFA is not the only program. Spoke to a borrower this week that she has applied to 3 different programs in Northern California. All of them involved lotteries, and they had like 3 to 5 grants to give away and had 5,000 to 10,000 applicants for them. So there are some other things out there, but as you can imagine, when anyone offers free money, there's a lot of people that would like free money, and your odds of getting it are not great.
Now, good answer. I mean, I've heard this, similar things from not just Josh, but other lenders as well. So I mean, it's difficult. Outside of California, you're probably in good shape to get some of these programs, but here in California, it's just tough. And then Tabib is asking, can I use down payment assistance with NACA? You don't need down payment assistance. I mean, it's pretty much 100% financing, I believe, in many cases with that program. So depending on where you're located, but I'm not 100% sure if they allow down payment assistance with it, but I think they go up to 100%. So I'm not even sure that you would even need it.
I'm going to pitch for you your video on NACA. And as you've said 1,000 times, the comment stream in there, there are a couple of people in there who say they have magically successfully closed a NACA loan, and hundreds of people saying, run far in the other direction of NACA. So I can't say that I've ever spoken with someone that's had a successful closing with NACA. I've spoken to more than 10 who had a very bad experience of wasting time, effort, and energy and getting priced out of the market while they were trying to get something done with NACA.
No, absolutely. Same thing here. So Danielle's coming back and saying they asked me for my CD account and I was advised to share.
Hold on, Jeb.
We got more?
Where did the $9.99 go? You had another one.
There we go. I didn't even see that.
Don't ignore the crypto payers. Oh, it's Charles. Okay. Charles was just tipping us in crypto for Does YouTube let you just convert it straight to crypto, or do you have to? to cash out first.
No, but I think you could do that in like Venmo and stuff now. Like people can actually
I
pay
saw it.
you. People can actually pay you in crypto, which is crazy. You pay me and I have no idea what to do with it at that point. Let's see here. So Danielle came back earlier, was asking about a CD. I took it as the closing disclosure she was asking about.
I did too.
But then I see her asking about whiting out something on it, an account number, which makes me think that you're talking about like a CD, like you have your money in a CD. If that's the case, yes, it would be normal. Like if I'm making an offer, you're making an offer with me. I'm your agent representing you. You're buying a property, and say you're putting 5% down. I'm going to ask you, where are those funds coming from? I need to provide to the seller, the seller's agent, that to show that you actually have that 5% that says you're putting down. And in this case, it might be in a checking account, might be in a savings account, might be in a CD. Maybe you have that money in a CD that's getting ready to mature. You're going to pull that money out, and that's where it's coming from. In that case, yes, seeing that CD would be viable. Like it would be part of the transaction. And yes, we would ask you to white out the account number, but we would provide that to the other side to show it. Now, in some cases, maybe you don't have a CD. Maybe the money's coming as a gift, right? From a family member or whatever. In that case, we're getting a gift letter. We're getting, a copy of where the funds are coming from. Maybe it's coming from your parents. Hey, can you provide us a copy of this statement along with, this gift letter showing where the money's coming from? We just want to be able to show the other side, like, hey, we actually have the money. I'll tell you a story real quick. I'll make this really, really quick. Listing a property here locally. This is a couple of weeks ago, and I get an offer that comes across my desk, and it's a strong offer. I think we listed the property for $625. This offer was at like $650. $650 was the offer, and they provide everything I need in the offer. And when I'm going through it, they provide me a copy of the down payment. And in this case, the buyer is putting $250,000 down or something. And the money is supposedly coming from a parent for the down payment. And great, not a problem. They provide me a copy of the parent's bank statement. Fantastic. I'm all good. Then I start looking at the bank statement in a little bit more detail. And I say, you know what, Josh, look at this. Does it look like these numbers have been altered? Yeah, it looks like the numbers have been altered. So I started going back through it and realized that they've altered the bank statement. So they're saying they have the money, but they don't. So the lender calls me and the lender says, hey, how does our offer look? And I said, well, we've got a problem. It looks to me like the bank statement has been altered. Well, what bank statement do you have? Well, we have a Bank of America statement. Okay. He goes, what does it show on it? I go, I'm not going to tell you that, because this is, I'm dealing with the agent here. She's the one that sent it over. He goes, well, it should show that they have 130,000. That's interesting. The one you sent me shows 230,000. So they altered it. So I went back to the agent and said, here's the deal. My client's not willing to work with your client because you guys have falsified the document. Well, here's the thing. They don't have the money now, but they're refinancing. The parents are refinancing their property and pulling that money out. And the money's going to come from the refinance, the cash out, and then they're going to have the money. Well, that's great. All you had to do is tell me that up front. Let me have a conversation with the lender. You tell me exactly where that money's coming from. Paper trail it to some extent. I'm good with that. But instead, try to falsify the information and you never really had the money. There's a problem there. So that's why we just want to make sure you actually have the funds, know where they're coming from, so that we don't get to the finish line and realize you can't close because, oh, wait, the money's coming from a refinance that you're doing over here that hasn't closed. And it's one thing if you know that, but it's another thing if you think that you have the money, or that the client has the money, and in all reality, they don't. So a long way of getting around to, we're just trying to make sure that the documentation's there, all the ducks are in a row so that we don't have problems at the finish line. So hopefully that was helpful.
Jeb, let's
Yep.
kind of audibilize off of that same conversation. Those people were unnecessarily trying to provide a false picture. Like what I would say is, if it was your buyer and we have them qualified, I would say, let me talk to the listing agent and even to the seller and explain the situation. Here's where we're at. I have a client that came from the show that we closed their refi 2 months ago, and they've decided to hold off on buying right now. But we had to go through that same conversation with a couple of sellers or listing agents and say, here's where we're at. This is a done deal. The loan's approved, docs are out, we're going to be closing, and we'll have the money in 8 days. So it was unnecessary to tell that story. You had a situation, the second form of wonderful malfeasance in one of your files, that a conventional pre-approval letter, conventional purchase agreement, magically you got a call from a VA appraiser. Is that correct?
That's correct. Hey, same property on
Awesome. It's a
on
Jake's
the offer that
property.
we accepted. Yeah. So yeah. Yeah.
So
So
yeah, tell us why they did that, what they thought they were benefiting themselves in doing that.
yeah, so oftentimes, right, in this market, you might hear a realtor say, "Hey, listen, you're only putting 3 or 5% down. Let's say let's show on paper that you're actually putting 10% down or 20% down because you have the money in a bank account. We can show it, whatever. And then when we get into the loan, we'll actually change the loan where you're only putting 5% down, or maybe in this case, you're a veteran, you could put 0 money down and buy the property, but we can't do that. So let's just do this and get your offer accepted. Then we'll change it." Here's the deal. The first problem there is that you've broken the contract, right? The contract that you've agreed on, both signed, says that these are the terms. If you change those terms at all, you're essentially invalidating that contract. That contract is no longer valid. The seller could ask you, a notice to perform, and you either do what they ask or they can back out of the transaction, right? And at that point, you might have paid money for a home inspection. You might have paid money for an appraisal. That money's gone. Okay. So that's essentially what happened here. I had an offer on a property, putting 10% down and conventional loan, and everything looked good, professionally written, great offer. And then, about a week later, I get a call from an appraiser, a VA appraiser. And I said, well, I called back and say, why am I getting a call from a VA appraiser when this is supposed to be a conventional loan? Well, we think that you should, basically that we should honor our veterans and let them do 100% financing. And I said, well, here's the deal. The reason we're not allowing 100% financing or a VA loan in this case is because we know there are things wrong with the property that VA isn't going to allow. And my seller isn't going to fix those. She doesn't want to address those. And that is part of a discussion we would have had up front had you submitted that offer. We know there are things wrong with the property. VA requires that the seller pay for a termite inspection and Section 1 clearance. We knew there were termites on that property. My client didn't want to deal with that. We were looking to accept more of an as-is offer, but they tried to change it, come back with it as a VA. We said, no, we're not doing this. We sent a notice to perform and said, hey, listen, you got 48 hours to either go conventional and release all of the contingencies, or we're canceling. Fortunately, they went back to the conventional loan and things are moving forward, but just shows you, having a professional on your side. In this case, I'm going to tout myself, knowing what to do and how to accomplish it is crucial, whether you're on the selling side or the buying side. If you got an agent telling you to do that on the buying side, you probably need a new agent, right? I mean, for one, it's not ethical. Secondly, it could backfire on you, and you could be in a different, and you could be in a bad position and spend money on something that's not going to go through. So,
as basic
yep.
as it sounds, follow the golden rule. Do unto others as you would have them do unto you. If you're a seller, do you want to know the person that you're dealing with? Like in that instance, if that was my buyer, again, Jeb's representing him and that's my buyer, I would say, Jeb, let me give you a detailed pre-approval package above and beyond what we normally do. Show how we could go conventional, but our preference would be to go VA. We will do whichever will get our offer accepted. But Jeb, how would that have changed how you would have responded or replied to them? In this instance, it sounds like the seller just wasn't going for it. But I would go so far as to say, I would say, well, we're in a position where we can pay for the termite clearance. You got to pay for the inspection. We got to see it. We'll figure out a way to do it. But if that had been presented to you that way, that a much better way to handle it.
Yeah, I mean, yeah, exactly. The story's being told. It's not like we wouldn't have accepted VA. It's just we wouldn't have accepted VA at that price. We had higher offers. The reason we went with this offer is because I thought, again, I was working with a professional on the other side. Everything was professionally written. It felt like a good transaction. And at the end of the day, it's working out and things are moving like they should. And it's going the direction that it should have gone to begin with. But it took some some arm twisting, if you will, to get there. And it shouldn't be like that, right? I mean, again, a lot of what clients don't see is all of that, right? The seller on one side sees that the transaction's moving forward, nothing really happening. The buyer sees, hey, I'm having to switch my loan. Why? They have no idea why they're being switched their loan, probably because, the listing agent's a dick over here and saying, hey, we don't want to deal with veterans, which isn't the case. It had to do solely with the property. And so there's a lot that happens behind the scenes. And so in that case, there's a reason why, right? I mean, it had to do with the property. But anyway, let's get back to questions here. So
they wouldn't have necessarily been wrong if they thought the listing agent was a dick, though.
That's fair. That is definitely fair. So John Doe is asking, is it proper etiquette to use both of your realtor buddies to find you a deal in the same market at the same time? Here's how I'd answer that. I would, if you're upfront with both of them, that, hey, listen, Joe is also looking to find me a property. Josh is looking to find me a property. Whoever finds it to me first is who I'm going with. Great. But I wouldn't be using one secretly and the other one secretly. Be upfront about it. And I can tell you, if it were me as one of those, I would say, hey, use Josh. Like, I'm not your guy. I'm not going to waste time and energy, especially in this market, trying to generate a property, find you a property to cut, and then find out that you're going with so-and-so because they found one. There's a lot of time, effort, energy that goes into the process. I want to work with people who want to work with me, who trust my expertise, my negotiating, my ability to make things happen for you. And so, I think if either of those guys are professionals, truly professionals, they're going to tell you, hey, look, I'm not the agent for you. And you should use the other one. And if they're both willing to do it, then you might just want to go pick a third and leave them both out.
Exactly. So Jeb, here's the funny thing. A viewer about 3-4 weeks ago had reached out. We went through, we answered some questions for them about both the experience they were having with their realtor that they didn't love, and the experience that a number of questions they needed answered in their loan that they weren't getting from their lender. And I always leave people with that and say, listen, use who you want to use. But if you felt the need to go outside of your lender to get these questions answered, that shouldn't be your lender. Much like what you just said about the two realtors in that situation that would be willing to fight each other to see who can actually close a sale. So the funny thing is, 2 weeks later, I get an email from him and he says, hey, I just wanted to know, and this was cool. I'm totally cool with this because he was upfront and honest. He goes, just want to know, we're still kind of in the same situation, and I wanted to know if we could apply with your company also, and then we can figure out in the process who's getting us better terms. And I said, unfortunately, no, because we do not get paid until the transaction closes. I'm not going to work for 30 days and then find out at the end if we get paid. And I said, so that's the big reason why. But the front end reason why is I'm going to give you all of the information you need to make an informed decision up front. And if you and I talk and we go through this and I give you numbers and you haven't reached a comfort level that I am better than the other option, then go with them with confidence. There's no need to push it off until the end. Now, in a real estate transaction with two people in the same town, they would likely be showing you the same properties. Imagine Jeb and I are both here realtors in Huntington Beach, and we're both showing you properties. There's only so many properties that are in your price range, in your neighborhood, in your school district. We're going to show you the same homes. It's problematic. And doubling the issue here is you're saying they're your realtor buddies. So these aren't two random realtors you found. They're your friends. So, Jeb, if you really wanted to hook both of your buddies up, would you say, hey, you guys want to work on this transaction? I know we see co-listings. Do you ever see a situation where there's a co-buyer's agent situation?
Yeah. I mean, to some extent, but even then it's like, I would just, in that case, I would just say, hey, work with and it's not because I don't want to work with the other one. It's just because, like, there too many chefs in the kitchen type thing, right? I mean, when you got a market with low inventory and the demand that it takes a lot of effort and energy to get offers accepted. I mean, right now, putting in a lot of offers for clients that are going nowhere, and nowhere in the sense that it's not that we're making crappy offers. It's that, we've got a lot of competition. And so depending on your market, where you're located, you're probably, you may or may not have the same situation. There's enough business out there not to fight over it. How's that? And fortunately, I'm in a position where I can turn down business if I don't want to do something. That's the point that you want to get to in a career as a realtor, is at the point where, if a deal goes sideways, or you find out, you lose a listing or whatever, that, okay, it's okay. Like, it's not my mortgage isn't banking on this deal. That's where you want to get. And and make those decisions. So just say, find somebody you trust again. And if it's because you have a hard time telling one or the other that, hey, this is who I want to use or whatever, then that's a little bit more difficult situation, right? Instead of saying, hey, I'm going to use John, I'm going to just say, hey, I'm going to use both of you guys. And that way, everybody, it's all fair and equal. I get it. That it's about relationships, but those two guys could talk to each other and figure out what works. I mean, one might be able to pay the other one a referral fee, and let one person do it, and that sort of thing. I mean, I've had that situation before, where the client wanted to use us both as agents, and we said, you know what, I'm going to do the transaction. I'll just pay Mike the referral fee, and let's move on. And things are fine. But that upfront communication is key in that situation. We got a lot of good questions here, but there's one I want to answer because there's two people asking it. One was related to Dennis is saying, is it a good time to become a realtor? He's in Long Beach. And then there was another up here basically saying that they were the first agent at a brokerage. I don't see the question at the moment. If you see it, click on it, Josh. But let's just address this question real quick, and then we'll move on. It'll be quick. Is it a good time to become a realtor? I think if your expectations are correct, it's a great business. What I think is there are more real estate agents right now than there ever been in history. Why? Because the market's doing well. Happens every time. When home prices start appreciating and business is really good, you get a lot of real estate agents. Same thing with mortgage professionals, or mortgage people in that case, not professionals. You get a lot of people wanting to do loans. Why? Because they think it's an easy job where you make a lot of money. And that's the problem, right? People become real estate agents because they watch whatever the shows are on HGTV. I don't know the names of them. Those shows. I thought one would come to my head, but none of them have. Anyway, they think it's an easy job. They think it's so flexible. You can just do whatever you want. You can go hang out at the beach. The reality is it's a grind. I was talking to my wife last night. She's like, we were talking about, I got another listing signed yesterday. What a great year it was. And I said, you know what? It's been an awesome year. I said, but the grind doesn't stop. It doesn't stop just because you've reached this level. It's not like it becomes any less of a pain to continue grinding, right? It is always getting the next deal. It is always closing the next deal. It is always putting deals together, negotiating. And guess what? If you sit around and do nothing, your paycheck reflects it. So you've got to be willing to go out there and not necessarily pound the pavement, because I don't door knock. I don't do any marketing. My business is primarily past clients, friends, and family. So I focus a lot of my attention on my sphere and the people that know me, like me, trust me, trying to build a business. But that in itself, along with dealing with transactions, talking to people on YouTube and trying to help, show you the foundations of real estate, it's all a grind. And so if you come in with the proper expectations that, hey, look, this is going to be difficult, but I'm going to do what I need to do to get there. Absolutely. It can be an awesome business, can be super rewarding. And there's a lot that goes into it. That makes you feel good, but it's not easy. And so that's what I would ask is it, or tell you, is if you're going into it with the idea that, hey, listen, it's going to be tough, but I'm going to stick to it and make it happen. Great. Welcome to the business. You'll do awesome. But if you're coming into it with the idea that it's flexible, you're going to be able to sit at home and not really do anything, and your friends are just going to call you when they want to buy or sell houses, not going to happen. I think the average real estate agent quits the business within 3 years. I think that's the stat. I haven't seen the stat recently, but I think that's the number. And the average real estate agent, here's what's going to surprise you. The average real estate agent makes an annual income of like $32,000 before taxes. So once you take out taxes, once you take out association fees, realtor fees, that guy's not doing it, or girl is not making any money, right? That's not a business. If you're making $30,000 a year, you're not in business, at least here in California. So anyway,
Jeb,
I'll get off my soapbox.
I had this conversation a week or two ago with a owner of a big mortgage company here in Southern California, and we got around to the different types of people. And this is no different in real estate versus mortgage. There are people who would be a very good realtor for you. They are not social, personable, marketing business people. So they're not hunters. They can't bring the deals in the door, but they would do a great job for you. And then on the flip side, there's the guy that's out on the street and glad handing everyone and is great at getting people going, hey, I want Tom to do my loan, or Tom to sell me a house. And then they're just terrible at the actual job. So just two pieces to it. Remember, not just, hey, I think I would be good at that job, or hey, I'm really good and have a big sphere. There's two pieces. You really have to be good at both. And probably the most popular model in real estate right now is there's a big super agent that does that marketing and brings the deals in the door, and they have a team of 2 to 5 to 10 agents underneath them that are actually going out and showing those buyers houses. The grind that Jeb talks about, that takes the marketing off of your plate, but the grind of doing the work is there every day, driving people around Saturday and Sunday, doing open houses, that type of stuff. So just go into it eyes wide open if you want to do it. I would never tell anyone that they can't do anything or that anything is not a good idea. Just go in eyes wide open and know that more people, vastly more people, fail than succeed at it.
No, absolutely. And there was another one. I forget what the other question was here. I was trying to find it, guys. I couldn't find it. But saying that you're the first agent in the office, new in the business, whatever. The key to being in this business is finding somebody, a mentor, a trainer, somebody that can walk you through the business, right? Understand, learn the business. That is the key, right? I mean, getting a real estate license doesn't make you a realtor, unfortunately. The training that it takes, the licensing requirements in most states to become a realtor, it has nothing to do with actually selling real estate. It's mostly to do with the legal aspects of real estate more than anything else. And so you need somebody to teach you the business. But I would tell you to build a business around, again, people that know you, like you, trust you. There are companies out there that will that have that business model that I get coached from, and I could refer you to those. I get nothing from it other than, again, like I say with the mortgage side, just know when you're in good hands. So if you ever have any questions, reach out. So anyway, let's move on. There was a good question here by Willing earlier about an appraisal, Josh, that I want to throw up here. We got werewolf. We got a lot going on here. Had an appraisal come in today, and it was marked subject to. I see a picture of some minor wood rot on the outside. Is the appraiser trying to tango? Should I tell him to back off, Lewis?
Is Nightbot masquerading here as Willing 7?
Hold on. But he goes on to say, I think he's a punk. He was late on providing the report and even tried to charge a rush fee when I told him up front, no rush. Gave them 3 weeks to complete. Now this, should I call Mr. Wick or Werewolf? So it sounds like maybe a loan officer here. It's hard to say, but
I believe Willing 7 was here last week, and they're a processor, and
here we go.
whether
whether
they should become a loan officer or go the other side and go to like closer or something.
So what's normal right now with appraisals? Let's just talk about that.
Varies tremendously by where you're at. For us here in Orange County, we're able to get them back in 7 to 10 days. I have a deal in Fresno that they quoted us 2 weeks, and they were not going to inspect the property. Actually, they quoted us 17 days. We were going to get the report back like a day or two before our contingencies were up. So they didn't even schedule the inspection until day 14. On day 13, this jackass calls in a medical emergency and says they're going to have to decline the order. So with that, in Northern California, in the Fresno area, they're backed up. So it took us another 2 weeks to get an appraiser out there, and that was with paying a pretty hefty rush fee, $200 or $300 rush fee. So if you're in a more rural area where there's not a large panel of appraisers, and even that part in the Fresno area, that's not bad. I got friends in like Washington State, and they're like, no, it's bad. It's 30, 35, 40 days to get an appraisal. So it just depends on where you're at. Now, if there's legitimate wood rot, it depends on the type of loan. Wood rot shouldn't be an issue. A small amount of wood rot should not be an issue on a conventional loan. If it's an FHA or a VA, they have different marching orders, and they're supposed to do a low-level home inspection and protect the buyer in that situation.
No. Good stuff. If you're watching right now, we've been over an hour and 10 minutes so far, 202 people watching, 57 likes. Would ask that you hit the like button, help more people see it. If you appreciate the content, appreciate us being here every week. So again, just a way of saying thank you. And if you don't like us, hit the thumbs down. That works. And that's what I just started asking people too. I'm like, listen, either hit the thumbs up or the thumbs down. Just hit something down there. Just, punch your screen. punch my face on the screen.
Hey, Jeb,
Yep.
we've actually got a good one here, and this is
All
a
right.
good excuse to do something else. Or a Ramirez. Where can I find a lender for a 2 or 3K loans for a first-time homeowner? And can you please explain a little bit more? So while I'm explaining, let's just start by Jeb and I have a big network. Jeb has a system for getting you connected to someone in your area who can help with that loan. So you want to put the little crawl up there, Jeb, so they have access
Yeah.
to
I'll see
your
what I can
form.
find here. It's
There
at
we
the end of
go.
this. Yep.
So, in the other part of the question, can you please explain a little bit more about a 203K loan? 203K allows you to finance the acquisition and renovation of the home. There's some limits on the types of renovations you can do. There's two types, like a mini 203K where you can do up to about $35,000 repairs, and then a full-blown 203K. The biggest difference is you're going to get with a contractor. Contractor going to prepare a bid. You're going to have a HUD inspector that reviews that bid and says, yes, those numbers are reasonable and you can accomplish that level of work for those dollars. And then the appraisal on the transaction is based on the after repaired value versus just the as is value. So you can get a home that wouldn't even qualify for financing otherwise. And as long as the transaction makes sense, bigger picture, you can get the money to do the rehab and the renovation. So it can be a great option if you find the right property. They're much more popular outside of our urban areas here where home prices and the heat of the market are making it harder, where there's lots of investors who will buy a distressed property like that. But it can be a great option. But either way, Jeb has the network and the form there to get you connected to someone in your area. Just jump in and fill that out, and he'll take care of the rest.
Awesome. I'm going to click this question just because it's right in front of me. Then we'll go back up here in just a minute. Closing date is November 25th. FHA loan, planning to stay in the property for a year or two. Could I rent out and purchase the second property as my primary residence? Absolutely. After a year, you can do whatever you want. Now the problem that you start running into, I think you can have more than one FHA loan at a time. But some loans, for example, if for example, you refinance that loan towards the end of it to get the cash out, you're calling that, your primary, the one that you have now to pull that money out of, and you're buying another primary, you might have some issues there. So just as you're getting closer to buying another property, maybe talk to a mortgage professional, have them analyze your situation, where the money's coming from, and just to make sure you're not going to have any issues with purchasing another home.
If we had a list of frequently asked questions, that might be number one. You guys really like to know how quickly you can buy another property or move and rent once you acquire the first one.
Well, hey, man, when property's appreciating 30% in a year, I want a bunch of
them. See how many I can get. I like that.
Let's see here. Dr. V, thank you for you. Yes, send me a link. Happy to have a conversation there. My email is somewhere there. You can find it in the description as well. Let's see. Michael DeRee, how is being a residential real estate agent versus being a commercial real estate agent different? A lot, in the sense that, commercial is very business based, right? It's based on numbers. It's based on a lot analyzation in a lot of case. Residential is based on emotion, right? People buy emotionally, they justify logically. Typically, commercial isn't an emotional decision. It's based on either a business model, trying to accomplish something business wise. Commercial can really be broken into two different sectors. One can be, you can have leasing. In residential, a lot of agents, for example, like myself, that sell property, help people buy property. I also deal with leases for clients, right? Helping them find property, sometimes helping them rent their properties out. Just kind of part of the business model. Whereas commercial, a lot of times that you're two separate agents. You're either an agent that helps people buy and sell property, or you're an agent that deals with leases. It can be two different businesses entirely. And depending on the type of business that you're selling, commercial can be way different, right? Because selling like a store or a retail business versus, another type of business is completely different based on the numbers of that business, what you're selling. Sometimes you're selling a business, sometimes you're selling a land or a building. There's just a lot of variances there. You have some agents that do both. I have no interest in doing commercial. just because I got my hands full with residential. I mean, commercial pays really well. There's a lot of people that are very successful and become very, very wealthy doing commercial real estate, but I can say the same for residential too. It's just less emotion on the commercial side.
The other big thing is a commercial agent will do less deals. So you have the lower volume but bigger commissions in general. So if you want to go that route, you should be
Takes
prepared
you
for
longer to get paid.
even more feast or famine. It's longer to get paid, fewer deals, further between deals with bigger commissions. I'm actually doing a loan for a commercial realtor right now. She does spectacularly. When you see the deposit, it's amazing. And then 5 months go by with no money coming in. 6, 7 months, 8 months, but then another big spectacular commission.
There you go. Let's see here.
Do you want to continue the Michael Dury portion of the conversation?
Yep.
So he's asking a question: how is your monthly mortgage payment calculated for the most part? Well, we don't have to go for the most part. It's super simple and straightforward. You're going to take a mortgage calculator. You're going to plug in your loan amount, your loan term, your interest rate, and that's going to give you the principal and interest portion of it. What else do we have? Taxes, insurance. So you're going to get your insurance quote. We add that in there. We'll estimate on the front end, but as soon as we have your actual insurance quote, we're going to plug that in. You're in Texas, Michael, way easier on the property taxes than it is for us here in California. They just look up the tax roll and they go, here's the property taxes. You could also have an HOA, you could have MI. We have to go to a calculator that looks up mortgage insurance, and you actually shop it just like you shop the mortgage, because the rates, they're not a huge variance, but a decent variance can be a $30, $40, $50 difference between mortgage insurance companies. So that's what it looks like. We're just looking up a bunch of different numbers, running the calculations, and then giving you a comparison, or at least an estimate to show you what those numbers look like.
All right, let's see here. Joel is saying FHA appraisal came in $20K low. Sellers got mad and asked for rebuttal. Is it true that even if the seller backs out, the FHA appraisal will stick to the property for 6 months? Is that true? Yes. There's a case number associated with that appraisal. Is it 6 months, Josh?
Yeah, and
Or is it 90 days? 6 months?
it's 6 months, and the appraisal runs with the case number. So the case number is attached to that property. Appraisal runs with it. So just remember, that's only for FHA financing. Right. VA buyer comes along, conventional buyer comes along, they're absolutely going to be fine. But if it's a strongly FHA market, it would definitely impact the seller's ability to accept another offer. And the rebuttal, it's not a problem. It's not a problem. Do it. Rebut it. I mean, there's no reason not to. If the seller doesn't feel that it's fair, have them and their agent pull together the comps that they think are more accurate. The one thing that I can say is that a large, I won't say the actual number that I think, but a large percentage of realtors have no idea how appraisals work. So when we get to that point on the rebuttal and we say, cool, I'm super happy to do the rebuttal, I just need the facts here. So find me good and valid comps that were overlooked that should have been used. And what I will usually get is homes further away from the property, like situations where we generally can't cross freeways. Will be what's on the other side of the freeway on the better part of the neighborhood. It's a property that sold 8 months ago versus, we have 2 that just sold recently that they're using. So it's just important to know that they have to be in geographic proximity to the home. They have to be recent sales. They have to be similar in size. I got a listing agent sent us a rebuttal or comps for a rebuttal. She goes, I got 6 good comps, sends them over. 4 of them are pending, or 4 of them are either listings or pending. Ours was a duplex, one was a fourplex that none of the comps they provided supported the value. So long way of saying, if you're worried that you're going to have to pay the extra 20, we probably get 10 to 20% of our rebuttals to change the value in the appraisal, meaning 80 to 90% go absolutely nowhere. So if we get the appraiser to change their mind, it's because we were 200% correct. So if they increase the value is there. Most likely they're not going to, and your seller is going to be comfortable that your lender did the legwork to try and protect them.
All right. There you go. Helen's asking a question. When you do a cash out refinance, do you have to account for what you're going to do with the money, Josh?
You know what's funny? In the automated underwriting system, it still asks cash out home improvement, cash out debt consolidation, cash out other. As far as I'm able to determine, your approval is not impacted by which of those you choose. We will occasionally get an underwriter asking us for a purpose of cash out letter, and we generally push back and say why the automated underwriting system doesn't ask for it or require it. But you'll get it occasionally. So generally, no, you don't have to tell them what you're doing with it. I wouldn't say you never do, but for the most part, you do not.
All right. Dream Vision. I saw this question earlier. Didn't get a chance to click on it. Got too bogged down here. But Chapter 7 discharge. FHA 2-year waiting period, 1 year into wait. Could I get pre-approved for a new build and have home built and close on 2-year waiting period? Will builders be okay with that contingency? I would say no to the second part for sure. A builder's not going to build with the contingency that you're going to be able to get financing a year out because, or 2 years out or whatever the time period is, just because what happens if that doesn't happen, right? But FHA, isn't FHA 1 year out of discharge?
No, 2 years.
Is it 2? Okay. So,
Yep.
Okay. Yeah. So you're probably just going to have to wait the 2 years, get a full pre-approval before you can start that, that purchase.
And depending on your qualifications, you would not be able to get an automated approval. So the builder's always going to say, you got to get pre-approved by my lender. I don't care who says you qualify, go to my lender. Their lender's going to run it through the automated system. It's going to come back, don't qualify. There was a BK within the last 2 years. So unless they could go through and you qualified under manual underwriting guidelines, which has a much lower debt to income ratio, they couldn't say one way or the other. They don't know. There's no way of knowing until you run it through the automated. So if you're at a more traditional FHA buyer at higher debt to income ratios, they couldn't tell you 100% certain at any point prior to 2 years after the discharge.
All right, here we go. Steven's asking a question here. Can my fiance's income be used when applying for an FHA loan through a broker if we only want to have my name on the loan? So Josh, can I be on the loan and use my wife's income without her being on the loan?
Yeah, you said wife, he threw fiance in there, use brother, aunt, sister, uncle, neighbor. It does not matter. If they're not on the loan, no one cares what type of money they make. If they are not signing the note and saying, I am responsible for repaying this loan as well, we are not going to be able to use their income.
No, agreed. Agreed, or that's a fact, rather. I don't have to agree. Let's see what else we got here. Willing 7 is just trying to take up the chat here, bro. Vicky's got a question. Vicky Singh, when is the best time to buy? When is the best time to buy a house, in 2022 or 2023, Josh? So we talk about this all the time, buy now or wait. So what would dictate that decision for you, in short, without let's dragging this out?
The only reason for waiting longer is if you knew for a fact home values were going to come down, or that they were going to stay level and rates were going to come down. The longer you wait, you have the potential for rates to go higher, the likelihood that home values are going to go higher. So unless you have a really good reason, like I'm going to graduate and have a new job, I'm going to just get a new job that I know is coming 6 months down the line, I get some type of certificate or training, unless something's going to change that is going to enable you to buy something more to your long-term liking further into the future, do it as early as your life stage makes it reasonable. So if it's the right time in your life to buy, you have good income, you have good credit, you have the down payment, do it now.
Yeah, I mean, I had this conversation with a seller yesterday. He said, should I sell now or should I wait until the beginning of 2022? And so, yes, selling is different than buying, but I guess my question would be the same. What do you think is going to happen? What is your reason for wanting to wait, whether you're buying or selling? Do you think the market is going to go up higher? That's why you want to wait? Or is there something else dictating the reason that you're waiting? And in your case, if you're buying, do you think prices are going to go down in 2023? Or like, what is the reason for that waiting period? That's what you've got to figure out. And then you got to figure out, again, like you said, like life, where are you at in that life stage? And what happens if the market does continue to appreciate? What happens if you don't buy in 2022 and home prices appreciate more? Are you still in a position to buy? That's what you got to decide. I mean, I realize it's an emotional decision. And what I can tell you is if you plan on being in the property 5, 7, 10 years, it's more or less irrelevant. As long as you can make the payment, you got money in the bank, you're not worried about it. You shouldn't be looking at your house. I tell you people this all the time. You shouldn't be looking at your house value on a regular basis anyway. Who cares what your house is worth? As long as you can make the payment, does it really matter? Right? I mean, are you watching what your Apple stock's worth every day? If you are, I feel sorry for you, right? There's a lot of variables there that play into the price of things and how they move. But I can tell you what, if you owned Apple 10 years ago, you know what? You're probably pretty happy today. And I would think the same thing would be with owning property. So, we can go deeper on that, but it's pretty much the same answer regardless of how we look at it. We got a couple questions here though, Josh, that kind of relate to the same thing. Let's see. Can I get an FHA loan without including my husband and his debt on the loan?
The debt part, no. You can absolutely get a loan without your spouse, and I guess so.
The answer is yes, as long
Well,
as they're not. Yeah.
with our California hat on, no, you can't get away from the debt. If you are in a community property state, FHA requires spousal debt to be counted against the borrower, even if the spouse is not on the loan. So depending on where you are, assuming you're in California or another community property state, you are absolutely free to not have your spouse on the loan, but you are going to count their debt against you.
But if you're in a non-community property state, you might be able to purchase the property, right? Just with your income and your debt, your credit. And if you can qualify, then you're good to go. Correct?
Yep. Yep.
All right.
Or if you could go conventional. She specifically asked about FHA, so it's probably a reason why she's leaning FHA, but you can go conventional and circumvent that. I have a refinance right now. Wife has a 690 credit score. Husband has a 630. We, for obvious reasons, wanted to leave him off. We took away all of his debt because he had roughly 50% of the debt in just his name. So we were able to get her qualified. So there's ways of working with it. Work with your lender and tell them what you're thinking, and they can walk you through it.
All right. Clips them easy. Do lenders sell mortgage loans to other financial institutions after close? If so, how often is it done? Any disadvantage? The answer is yes. Oftentimes they are sold after the close. How often? I would say there's a pretty good percentage of the time, depending on who you got your loan through initially. Any disadvantage? No disadvantage at all. It's a regular thing. It happens all the time. Nothing to be concerned with. Yeah, not a big deal.
Is it a regular thing or a normal thing?
It's both. It's a normal, regular thing. It's a regular, normal thing.
So
here's a question. Go ahead.
I would say almost always they're going to be sold. It might be transparent to you. There are lenders that sell the loan but keep the servicing, and the servicing is the piece that you care about. That's whose portal do I log into to look at my account? Who do I make my payments to? They're all essentially the same or similar. Some are better than others. If you call in for customer service, it's all going to be a young person that's not super knowledgeable. So from that perspective, it doesn't much matter to you. And the likelihood of it selling or transferring rapidly relates to the value of that servicing asset. And we're coming off of a market the last few years where rates have been decreasing. So loans are paying off really rapidly. So the servicing has been sold less the last few years because the companies that sell the servicing are making less from those sales. That will change in the future, but everything Jeb said is 100% correct.
All right. Little this and that. Is it illegal for a seller to sell me a $400,000 home for $250,000 if the buyer isn't a relative? No, the seller can sell it for whatever price they want to. There's no law out there. I had somebody reach out to me early. I mean, in another video, it might have been you. I don't remember. Asking me what they heard it was illegal to sell a property for less than it's worth. No, a seller can sell it for anything they want. There's no guidelines on what a property can be sold for. So
I'll throw an additional piece of info in there, Jeb. My wife's a wholesale account executive, so she deals with lots of mortgage brokers like me, and then has to deal with me at home at night, which is a whole different story. But she had a scenario where the guy's trying to say, hey, this guy used to rent a room from this other guy, and that guy's going to give him the house, and then he wants to do a cash out refi. So there's nothing preventing that guy from giving him the house, but it also sounds batshit crazy. It was $1.5 million house. No one gives someone that used to live with them $1.5 million house. Someone certainly could not know or be aware of the value of their home. And if they don't know it's worth 400, or if they just want to out of the kindness of their heart, just be prepared that there could be some questions. Why are we doing this? Why are you getting this for less than market value? And they could even go so far as to ask the seller if they're aware and why they're doing that. And if you have the property tied up under contract, it's not like they can back out because they become aware of it, but just it's a little bit of additional information and color there to the answer to the question.
All right. So Chris told me to turn off the crawl. While I don't like being told what to do, I did turn it off because I completely forgot it was up there. So I I did your request. So that's $5. Thank you.
I only respond to super chat requests.
Yeah, to crypto money. Let's see here, Josh. You see anything that sticks out?
There was one right here. Just got to get back to it real quick. Where did it go?
Okay, here we go. Well, I was gonna there was one earlier that asked me.
Well, here,
Go ahead.
this
Yeah,
relates back again sort of to
okay.
timing.
I saw that one a minute ago.
Is that Senora Herrera? I think it is. Senora Herrera says, should I try to get a $500,000 house with a $30,000 down payment? I have a good stable job and great credit, but I don't have a lot of money for a down payment. So what I would say, that's 30,000 is enough for a 5% down payment at $500,000. So we can go conventional. We could do less. We can go FHA. We can do a 3% or 5% down conventional. You can do a 3.5% down FHA and have $5,000, $7,000, $8,000 left for your closing costs. That is more than enough to get this done. And like you said, you have stable employment, you have great credit. 30,000 is it's not insignificant. That's plenty. We get people into, $500,000-$600,000 homes with less than that, or don't have that amount of savings. So I would say absolutely jump in and see what you can do in the current market.
No, good. Victor, don't put your question in more than once, my friend. That's all I wanted to say about that. First time buyer in Corona Riverside. I've been second place on every offer I've made. I've lost count. Anything I can do besides continue to save money to make offers more competitive, 5% down, conventional. Yeah, I mean, there are definitely things that you can do to be more competitive. You can shorten contingency periods. You can get rid of potential fees that the seller is typically responsible for paying. You can put those on the buyer side and pay for those. There's, ways to shorten the closing date, the full escrow term, find a lender that can close sooner, put 21 days as your closing versus 30. I mean, there's a lot of things, right? You can use escalation clauses. But what I could tell you more than anything else is make sure you got a professional. This sounds very, what's the word I'm looking for here, Josh? Self-promoting, me saying that you need to work with somebody, but find somebody that knows how to do these things and can have a conversation with you about what to do in order to help your offer stand out. Maybe in some cases you are doing an appraisal waiver, but you're going through the comparables up front to know where the property is likely to appraise so that you're not putting yourself at risk. You're not just doing it on every transaction and going willy-nilly, if you will. But you're making sensible decisions in how you approach those offers. In fact, we have a similar situation right now with someone we're working with that's in, similar market, doing exactly what you're doing. We've had a lot of success out there. I have one of my agents that works with me that does quite a bit of business out in that market. And he's having success getting people in escrow. And it's because we're doing a lot of these things to help offers stand out. And a lot of it becomes communication, trying to get rapport, relationships with the other side, to show them, hey, look, you're working with somebody that has good intentions and wants to get their client to the finish line and where everyone's happy, right? And so it's a lot of times you got unexperienced people out there just putting numbers on paper and don't know how to follow it up and communicate, not include the realtor, the lender. There's a lot of pieces to the puzzle there outside of just putting in a price on an offer to help them stand out.
We got one accepted this week that I've told you guys here on the show before. It's hard to get listing agents to pick up the phone. Some of them they're getting 20 offers. They don't want to talk to the 3 or 4 lenders that are actually willing to give them a call. But we had one this week where they didn't pick up, didn't answer, and I followed up with a video just walking through everything. So emailed them a video explaining everything about our client, why they're awesome, how long we've done this, what we have, where we're at, and why this deal should close quickly. And she ended up accepting the offer, and she told our buyer's agent, It was a well-written offer, well presented, and then your lender, following up and giving us that information made my seller comfortable that of the 4 or 5 offers, yours was going to be the best and easiest and smoothest transaction for us. So exactly what Jeb is saying is you need to give the other side confirmation that you're professional, reliable, trustworthy, and that you're going to be easy to work with and help them look good to their client through the transaction.
No, absolutely. Floyd. So Floyd, no, I clicked on the wrong.
Mayweather?
Floyd, not Mayweather.
Oh,
I don't think he's
he's a cash buyer. He don't need
yeah,
us.
he doesn't need a loan. He might if he continues to spend money the way that he does. With the bidding wars going on in SoCal, should I give up using a VA loan? I would say no. You don't need to give up. You shouldn't give up, but you should have proper expectations, right? You should know what you're getting into. It's in some situations, yeah, if there's multiple offers, but sometimes you can get, we had a VA offer accepted, I don't know, 2 months ago and got one closed. I accepted an FHA offer on a property I had in Seal Beach, I don't know, 2 months ago, 3 months ago. So they're getting done, but it's again, it's all about the agent on the other side understanding the loan, understanding, having a conversation with the agent on the other side to know that there's not going to be any issues. There's a lot more that goes into it than just knowing the type of loan, right? You want to know that you got somebody on the other side that can get it done. But I wouldn't give up entirely, but you just need to know going in, it's going to be more difficult doing it.
Everything that we just said about getting the lender involved in every offer presentation is like 10x on a VA loan. There are massive misconceptions among realtors of what it means to accept VA financing. And the earlier we can get on the phone with them, or even just give them a video of walking through and saying, I am happy to get on the phone and answer any and all questions that you may have. Sort of like the guy tried to browbeat Jeb into allowing them to violate the contract and transition to a VA loan that they intended to use all the way along the line. His thought process of saying, hey, I believe that veterans should be able to use the benefit that they've earned through their service to this country. I do too. And we just want to tell the listing agents that up front. And what does it mean and what does it not mean? By all means, if someone has a 20% down conventional loan with a appraisal waiver, or they're waiving their appraisal contingency, I get them accepting that over a VA loan. But I don't want them doing it because they misunderstand the VA program. What I would say is the VA loan is the most forgiving of all of them. We have the most success with VA appraisal rebuttals. There are a few things like Jeb mentioned in that earlier VA discussion. We have to have a termite clearance. So some of these things come up in terms of condition, but they're flexible loans. They're amazing for the veteran. You've earned it. And if there's no cost to the seller in terms of time or net at closing, there's no reason for them not to accept your VA offer.
All right. Agreed. Let's see here. I found one a moment ago. We'll just go with this one. Epifanio Vargas. I have no idea. Self-employed for the last 4 years. What are the requirements to qualify for a loan? And let's just address it. Self-employed or not. Someone asked a question earlier, and I meant to click on it, lost it. But what are the requirements to get a loan, Josh? What do you need?
So you're going to document income, assets. We're going to pull credit. You need to give us a complete loan application. That the important parts of that are just some basic background, demographic information, social, date of birth, family size, marital status, that type of stuff. So you're going to start with a complete loan application. As part of that, we need a 2-year residence history. We need a 2-year employment history. And what we're talking here in the employment history, how do we validate and verify that? So for the assets, we need 2 months of the asset statements. If it's an account that has a quarterly statement, we need the most recent quarterly statement. So that's for any of the assets that you're going to use. For income, FHA and VA loans, we're going to always have to do 2 years. For probably 70-80% of our conventional loans, we only need 1 year. But just to make this simple, let's say 2 years for every loan type. 2 years of pay stubs and W-2s For a self-employed borrower or anyone that owns rental property or has ownership interests in other businesses, we're going to need 2 years tax returns and then 2 months of the bank statement. So loan application, 2 years, 1 month of pay stubs, 2 months of, or 2 years of W-2s and tax returns, and a complete loan application. And with that, it's not going to tell you that that's 100% of what we need, but we're going to be 90, 95% of the way there with that documentation.
All right. Stephen has a good question here. How does rent income come into play on how much you could finance when it comes to duplexes, where you live in one of the units and rent out the other? If I qualify for 300,000, but the duplex with 2 units is priced at 450. So Josh, when you're buying a duplex, how do they take that other unit into consideration?
So when the appraisal is done, they're going to do a market rent survey and they're going to say, this is how much the other unit will generate in monthly rental income. And you're going to get 75% of that added to your income for qualifying purposes. And the reason why 75% instead of 100 is there's going to be maintenance, upkeep, vacancies. So they use a 25% maintenance, upkeep, and vacancy factor since you don't have a history of owning that property. So if unit number 2 would rent for, let's say, to make it easy, $2,000, 75% of it is $1,500. We add $1,500 on to your qualifying income. And in the current market, again, to make it easy, let's say 50% of that can be added, if we're at a 50% debt to income ratio, we have $750 of additional monthly payment qualifying power. So at roughly $5 per thousand, we have just about $150,000 added to your qualifying, but those are all hypotheticals. So talk to your lender, say, hey, this is the property I'm looking at. This is what I'm able to determine that market rents are for the other unit, and see if it will get you from 300 to 450. And if your lender doesn't understand that, your loan officer is confused by it or doesn't want to do the work, find a better loan officer.
I like it. Joseph, what are your thoughts on what's happening in the Chinese real estate market? Josh, we haven't really talked about this very much on air. You got Evergrande, right? Some things happening over there. Here's the thing. It's hard to say, right? I mean, the problem with China is that you don't know what's accurate and what's not. You don't know how bad something really is or how good. Well, you know how good something is because a lot of times it's falsified, right? I mean, the problem is a lot of their information isn't well documented. But even then, with Evergrande, for example, it goes belly up. A lot of what I've read is that the Chinese government is essentially going to take whatever funds are left from that company to finish the projects that are already in the works, so on and so forth. Could this have a big effect on real estate? It's hard to say. Like, honestly, I mean, everything I've read doesn't, it seems like it's pretty contained within China. But I mean, could it spill over to the US to some extent? I don't know. Josh, I mean, what are your thoughts on that? I honestly, I don't think so, but hard to say.
Yeah, really, that's the right answer. Could it? Yes. Should it? Will it? Probably not. Unlikely. And the piece that I would say, I'm not interested in the concept enough to really dig into it to tell you authoritatively. But the authors and experts that I read and follow, no one's all that concerned by it. They're interested in it, but not concerned by it at this point.
Yeah, and there's also a way that China, allows people over there to own property. There's a lot that goes into it in the development of it, and I've read on it, and again, like Josh said, it didn't interest me enough to dig any deeper into it because it didn't really seem like it was going to be a big problem. I think it's more of a headline than it is anything else, right? I mean, this is something that came out a month ago that was going to collapse, the entire market, but yet it's kind of dissipated to some extent, right? It's no longer the major headline that's out there. You have to understand here, within the news cycle and anything, that people have very short memories. So unless it's something that's constantly a problem, it becomes a headline and then it's gone. And that's a lot like what's happened now, right? I mean, it doesn't seem to be a big enough issue to continue to make the headlines every single day. So again, I wouldn't be the one to give you the best opinion on it because I just, like Josh said, I haven't dug deep enough into it, but I think it's because I don't think it's that big of a problem. Clip Some Easy has another question here. Can one purchase their parents' house if their parent is relocating? House is valued at 950, but parents selling to child for balance left 200K. Yes, in theory they could, but they would be getting no money from the sale of that property, right? I mean, there's no money. They would only be paying off the loan on that property with the 200 that they're selling it for. So therefore, the parents would be walking away with no money unless there's some agreement between you guys outside of that agreement to pay back the additional money. But if you just pay 200,000 for the house, that's just paying off the mortgage on the loan, and you're getting a loan for that 200K. So your parents, there's no benefit in your parents' case other than they're getting their child a home for 200K. But they could also do it differently, right? They could just sell their house for 950, pay off the 200K, and then give you the house, and they would be in the same position. I mean, it would be in the same financial position, except for you wouldn't have a loan in that case. So I don't know that I understand the question entirely, unless I'm missing something there, Josh.
Yeah, selling the house to a child is fine, and for any dollar amount, as long as it's going to pay off the underlying debt. So in this situation, the bigger question is they wouldn't want to do it for exactly $200,000 because they want to make sure that they have their closing costs covered. They don't want to write a check to close. If the child cannot pay their own closing costs, then they're going to want to again increase it so they can say, hey, we will pay all of the closing costs. And then also, if the child is getting a loan to take out that $200,000 balance to put that loan into their name, they're going to need to make a down payment. So we don't really want to do the down payment unless we have to. So we would probably want to structure to say a $250,000 or a $300,000 sale with a gift of equity. With that, we can put all of the selling costs on the seller side, the parent side. Child can come into it with absolutely nothing and have a mortgage with no mortgage insurance. So all of those things are things to consider, and we get this a lot. I would say 4 to 8 times a year we get involved in a parent-to-child sale transfer like this, and no one quite understands all of those ramifications. So talk to a lender that's done this before. It's one of those areas where, good Lord, most of the time when someone gets to us, they've already talked to someone else who's given them the wrong answers and the wrong information. So again, talk to someone that does this regularly, can advise you on all of your options, the pros and cons of each of those options, and help you make the best decision for you and your family.
There you go. Let's see here. Question about the roof. It's been 3 years, been fighting with my home insurance, and now I have mold. They only gave me 12K. That's not enough. That's not even enough for my roof. What can I do? Go back and fight with the insurance company. Nothing you can do. It's right. It's dealing with an insurance company. If you can prove that you got mold in a time that they were waiting for that to go through, you probably have a case of some sort. So you might have to get an attorney involved. I mean, there's could be a lot going on there, and unfortunately not an easy answer. Lewis says,
It's Lois, bro. Don't make
oh,
Lois mad.
what is that? A O? That's a no.
You're not old, and you're not old enough to need glasses or have vision problems. So I don't know what you're doing.
LASIK 10 years ago was great, and I guess it would have been Luis anyway. But anyway, Lois, hey Jeb, I have had problems locating properties for my clients for FHA lending in the price range of 640,000 or below. Do you have any information for locating off-market properties due to bidding wars? No, not really. Nothing that you probably haven't heard of. The best way to get off-market properties is to door knock, send letters, that sort of thing. Talk to agents that are in the markets that you want to be in. Maybe if there's someone that farms a market, or there's a dominant agent in a market, talk to those people. Oftentimes they might have a property that isn't on the market yet that you might be able to do something with. But outside of that, not really. I mean, I'm not one of those agents that's out there necessarily pounding the pavement looking for off-market properties. It's more if they come to me, and or if I have a client looking for something specific that's not on the market, then I'll reach out to my network. But outside of that, I don't really have any plans.
Jeb, I have a lender that I'm friends with on Facebook that actually I saw a post last night. I'm like, I don't know that it's going to be successful, but it certainly couldn't hurt. Just posted, hey, I just got someone fully pre-approved. They're looking at a very competitive market out in the Marietta area, and just said, hey, they're qualified for this. We can close it in 21 days. If you have a new home coming to market, or if you're thinking of selling your home, let us know. I don't know. I don't know how many contacts they have on Facebook. I don't know how far and wide that would go. But again, there's no downside to it. And for Lois, the other thing that I would say, I don't know. I know that of mailers to sellers, the most successful mailer you can do is the I have a buyer mailer. So most of them are still going to get thrown in the trash. But if they have a specific area that they're looking at, you can mail the shit out of it and see if someone
Yeah, and I would say if
responds.
you're going to do that, get specific on the letter. Don't just send a letter out, I have a buyer. Hey, include the name of the buyer, include a photo of the buyer, the family. I mean, honestly, that sounds crazy, right? But if you get something, because everybody's doing the same letter, and let's be completely transparent and honest here, it is for marketing purposes. Most people don't even have the buyer. It's just to try to get listings. But if you truly have a buyer, show them, this is my buyer. Why do they want to live in the neighborhood? Give their name, right? And provide some detail with it, because again, emotion. Properties sell with emotion. Sellers have emotion. They want to know who's buying my house. Why do they want to buy my house? All of that good stuff. Be specific, because that stuff can stand out and help you, in a market where they are maybe getting a ton of offers, or a ton of letters rather, on that sort of thing. Also, video. Do video. Do a video, advertise it on Instagram, on Facebook, get super specific with the area that you want to be in. Tell people, hey, look, I have a buyer. They're pre-approved. They're ready to close. We can't find a property. If you know somebody looking to buy or sell, if you're looking to sell, call me. Sounds crazy, but people are on social media all day. That stuff can stand out. Let's see. I saw this early. Oh, this isn't the same one. Someone asked earlier about refinancing a HELOC every year, which you can answer that too. But can I use a HELOC for a down payment on an investment property? Getting conflicting information. Josh.
Anyone that tells you no should be disregarded and ignored moving forward. So what you cannot do in a real estate transaction
Like
is use unsecured borrowed funds. So a credit card, something along those lines. But a HELOC is a secured loan. So we document that you have the HELOC, that you're taking the money out, and from there we have to show it coming out. So you would generally wire from your HELOC account to your bank account, or directly into escrow, and then we have to document what the payment's going to be and count the payment against you. But 1000%, any form of secured borrowed funds can be used in a real estate transaction.
All right. Awesome. This is a question that we get all the time, but it's worth addressing. Corey says, how long is a pre-approval good for? My typical answer is 90 days. I know your answer is going to be, and is good until unless something changes. But you want to elaborate on that at all?
No, I mean, that's essentially the right answer. I mean, things are going to expire. Your pay stubs expire in 30 days. So technically you should be refreshing, renewing that as you go. But as long as you know that nothing in the underlying scenario has changed, you still have your job, your pay rate's the same, you didn't spend any of your money, you didn't miss a bill or buy a new expensive car, you're fine anyway you cut it.
Michael DeRee asked a question earlier too that I wanted to get
Let's
ask. Go ahead.
do you
if you
do
got
you
one.
have it?
No,
There's a good one here. So Victor is asking, I want to buy now, but my credit 690. Should I wait and go conventional, or do it now FHA? So I told you guys, we talk about our friend Kyle Seagraves on the show. He's got a wonderful channel. He threw up a new FHA video this week, and this is not to in any way contradict Kyle. He gives great information. Love his channel. But one of the things that he said in there is that FHA loans have higher rates than conventional loans, which on the broker side, they're much lower. If you go to a direct lender, that's accurate. I've talked about on here before the Optimal Blue Mortgage Market Index, and it shows you direct lenders across the country, the rates they're actually locking today. And if you look at that, the FHA rate is slightly higher than the conventional. I can tell you on the broker side, we're 0.5% lower FHA than conventional. One of the really good points that Kyle makes in that video is that you have you're paying for in two ways for mortgage insurance on an FHA loan. You're financing a 1.75% upfront mortgage insurance premium, and then you pay the 0.85% monthly. What I would say is have your loan officer do a side-by-side comparison for you of a FHA and a 690 conventional, and then a 740 conventional, and see, is it worth waiting? In my experience, unless you have multiple borrowers, because that drives the mortgage insurance rate down, and really high credit scores, more in the 760, 780 range, the FHA will have the lower payment. You still have the additional cost of the mortgage insurance, but the FHA will have the lower payment. And when we're sitting here talking about, do we wait? If the market goes up 1% a quarter, 4% annually, any difference in the savings, waiting 3 months will be eaten up with that.
All right, we're pushing it close to 2 hours here. I'm going to answer a couple more questions. If you're still watching, you haven't already, hit that thumbs up, hit thumbs down. Doesn't matter. Just hit something. Anyway, this is a good one. We get this often too, but we kind of addressed it earlier. How soon after closing can I refinance my second and first to combine them? I did a 10% down payment. So what they're saying here is that they had a first mortgage at 80%. They had a second mortgage at 10%. The reason they did that is to avoid mortgage insurance. So now they have two loans. They're wondering, hey, I've got appreciation in my property. When can I combine both of those loans into one loan, not pay mortgage insurance, and move on? So Josh, what's the answer there?
So Jeb, that really is the question here. How do I get rid of my mortgage insurance, which is having a second mortgage that's either at a variable and or higher rate than my first? So we cannot use the appraised value until 6 months after you close. So sounds like the market's gone up, probably 10%. And we cannot use that value until 6 months after you close. So once you hit the 6 month mark, we can close. So you don't have to wait 6 months. We can start on that loan in 5 months and order the appraisal. Appraisal comes back. We just can't use that new appraised value for 181 days. Now, if we're thinking we need more appreciation to get to 80% or below, you might want to hold off 6 months to order the appraisal, or wait 7 or 8 months. And the other thing that is important to note on here, combining a purchase money a second mortgage you use to purchase the home, is not considered cash out. So it's treated like a rate and term refinance.
Good. I'm just thinking out loud. It's hilarious over here. I'm reading Willing's comments. These things are just, they're next level down here at the bottom. Good stuff. Let's see what we got. We'll answer one more here. Let's see what we got. Can we find a good one, Josh?
What do you think about this one? So Lori Bauer says, I'm refinancing my primary, but I'm currently under contract on an investment property. Could my refi rate change due to the investment? Absolutely not. We don't look at other properties and what else you own unless you got to the point where you had more than 10 financed properties. Could throw things into a tailspin there. But what they will look at, if you're under contract, the way we got a new loan application for the first time in like 25 years earlier this year, and it asks very specific questions if you are in the process of acquiring any other real estate and if there's going to be financing. So you do have to disclose that, and you want to make sure that owning the other property doesn't prevent you from doing the refinance on your primary. If you're qualifying for the purchase of the investment property, you probably will still qualify for your refi. Just be careful and make sure you disclose everything.
All right, guys. So 2 hours here. We're going to wrap this thing up. As you guys know, many of you know, we're here every Wednesday night at 5 o'clock to answer mortgage and real estate questions. I can't believe some of you guys still come here. You've been coming for over a year. I'm surprised. I really am. Every time I get home on a Wednesday, my wife says, "How was it?" I'm like, "It was good." She's like, "You're not getting tired of answering the same questions over and over again?" I said, "No. I mean, every week there's at least a few questions that come up that we haven't addressed that are good questions. And so it keeps the show rolling on, and hopefully people find value in that." So, I'd ask, if you did find any value, hit the thumbs up. Josh, what are your thoughts, questions? What do you want to get off your chest tonight? Is everything going okay with the pool, with surgery coming up? Where are we?
Life is stressful, so
Nice.
we're finishing the renovation in the property in Orange and have to get it rented out. I'm leaving to Idaho for a quick pit stop to see my uncle who's not doing so well, and then heading to Washington to have my shoulder replaced. And they're going to be working on my pool while my wife and I are away from our home. For
Oh,
control
that should make you
freaks,
feel really good.
yes, for control freaks who like to watch every step of the process. It's a stressful time. It's all good. First world problems. No one feels sorry for Josh, but it's been stressful.
No, all good. Yeah. So you guys, if you're watching this after the fact, put your questions in. We'll try to go back and answer them. But for now, appreciate you guys being here. Appreciate all the support. Adios. It's that time, people. See ya.